The CNBC Rapid update median of tracking forecasts on the street down a tenth for the third quarter after that disappointing retail sales report this morning and disappointing inventories. We're now at 1.5% for the just completed third quarter. That is the lowest tracking we've had, and it has weakened substantially as we've gone along. Of the last 6 indicators that have affected the tracking forecast, 4 have been negative, 0 have been unchanged. Take a look at who's where now. HFE is at the top, still at 2%, whereas Goldman is at 1.7, Action Economics and RSM, they're at 1.4, and now Oxford Economics at the bottom at 1.2. Also bringing down, by the way, the outlook for the fourth quarter. That is now 1.7%. Our last read on that, it was 1.9, Scott. These are forecasts for the fourth quarter, no actual data yet. But as you know, the CNBC Rapid update is the exclusive look that we do of how a given economic number in a day affects Wall Street's view on GDP. Scott?
Well, the other thing is, how can the Fed look at those numbers? And I guess I'll say Charlie Evans specifically. If forecasts are coming down and the retail number was a miss for the first time in 7 months, how can he say that rates are in a good place, that he's fine with where things are, even while saying he has an open mind?
Okay, so without agreeing with him, Scott, what I'll say is this. This 1.5 to 2% range is very much in line with what the Fed believes the potential of the economy to be. Wall Street and the politicians may have a 2% or higher number in their heads, but Evans today, in fact, used that number of 1.75% as the average, or what he expects a potential growth to be. In that regard, we're in and around there. I will also say that while everybody saw the retail sales as disappointing, not everybody was quite ready to write off the consumer, in that this is seen somewhat as a bounce down from a bounce up in August, or just a retracement or a regression to the mean when it comes to the strength in August. So I think a lot right now, by the way, riding on the data that's happening right now that we'll get in November, retail sales. If indeed the consumer weakens, then I think we have to worry about a sub 1% or a low 1% GDP growth. And that's when I think, Scott, the Fed's going to start to be worried.
Let me ask you this question. It's going to be a pure guess on your part, so forgive me for putting you on the spot.
Seven.
If the Fed was meeting today,
Okay.
If the Fed was meeting today, would they cut rates?
I think they would, but I'm as sort of eyebrow raising on Charlie Evans as you are. Charlie's a voter. We know Rosengren doesn't want to cut rates necessarily. We know George doesn't. We could be set. I don't think Charlie's going to dissent, if I had to guess. So I still think Powell has the votes, and I think Powell wants to cut one more time. But it is possible, given what Charlie said today, he could do so with 3 dissents against cutting rates. So that would start to get to the edge where the Fed might not act. I think the market, though, what I saw today, Scott, was an 85% probability still on those cuts, and that came after Evans. So the market thinks the Fed is going to do this, and they would be most disappointed if it didn't happen.